Good afternoon, everyone. Welcome to Centennial Advisors' first webinar of January, or first webinar of 2022. We thank you all for attending. Today, it's really exciting. We finished last year off doing a webinar on what we think is an opportunity zone secret, and in the last 8 or 9 days of the year, I think we ended up saving clients between $5 and $6 million in current tax obligation from the information that they found on the webinar. So we thought it'd be great to kind of do it again without the urgency and the push of a deadline 8 days away. Maybe educate all of you on some of the opportunities that you have in opportunity zones. It's been around for a little bit, but maybe not as effectively utilized by a lot of the residents of California and across the country as it could be. And we've learned a thing or two over the last few years investigating it. And now we're excited to show you what we've come up with and maybe educate you a little bit on what you can do, how you can avoid some taxes, and the variety of options you have within the opportunity zone. Today, I'm joined by Jason Brooks of Buckhalter. Jason has a ton of experience in all real estate, I guess I would say legal matters, but has a ton of expertise in opportunity zones. He and I first met a little over 4 years ago at an event hosted by an escrow company, just as opportunity zones had come out. I think it was early 2018, and everybody was trying to figure out what the opportunities would be and how everybody could make money. Got the chance to meet Jason, and over the last few years, we've worked on a number of transactions and really explored opportunity zones and what somebody could do, especially what somebody can do to take advantage of the tax benefits, but also passively or as passively as possible control their own real estate within opportunity zones. So Jason and I are going to talk about that today. Jason, thanks a lot for joining me.
Thank you for having me. Looking forward to it.
It should be fun, and we should be good at this one since we've already done it once. Why don't we get started and talk a little bit about the history of how we got here today with opportunity zones?
So opportunity zones were passed and became law in 2016. I think one of the important things to note and keep in mind is this was a bipartisan bill. This was a bill that had support from both sides of the aisle. Why is that important? You know, from time to time, people ask us the question, well, are opportunity zones going to go away? If I start this process now, is this going to change? I think safely we can say the answer to that is no. They do expire right now in December 31st of 2026. But what they were, the purpose of the opportunity zones was for people to reinvest capital gains into areas that might need, I don't want to say gentrification, but reinvestment, expansion, growth, redevelopment. And, I get questions all the time. Are these, rougher neighborhoods or bad areas? The answer to that is actually no. There are actually some, as Justin and I know, some really great areas. I mean, we've got a property we're doing right now in Virginia where, the area median income, I believe, within 5 miles is $135,000. There's some really great neighborhoods and areas where we can invest in. And so it's a really great opportunity to save on taxes and get, tax-free appreciation on real estate.
Jason, you advise a lot of investors on opportunity zones. In your opinion, how has it worked, or has it worked as effectively, or has there been as much activity in opportunity zones as we expected in the early parts of 2018?
So I think right away in 2018, we had some activity and people starting to take advantage of it. And then, there's been a couple artificial, I would say, deadlines that have pushed people to make decisions more quickly. So at one point you were getting a 15% reduction in the tax bill. And then at another point at the end of last year, if your money was in, you got a 10% reduction in the tax bill. So a lot of activities have happened around that time frame. We've seen some really large scale developments occur, but I think what you and I have found, and I think what Centennial is really helping like my clients with and your guys' own clients is how to specialize when, somebody has a $1, $2, $3 million gain to put their money into an asset that they can control, a self-directed fund versus, a larger fund where they're paying fees to a developer.
Fantastic. Let's get into the mechanics of it. We're going to pull up a slide here in just a second.
While you're pulling that slide up, Justin, I think the interesting thing is, right, and a lot of times when people look at investing in these deals is, they're concerned about paying a developer a fee, right, or losing money to a third party. I think what hopefully, we've helped a lot of clients with at the end of the last year and at the start of this year is how can they, do their own deals. And so that's something we can really focus on today is helping an individual, smaller, mom and pop investor that might only have, $700,000 or $1 million in gain.
So let's get started. Let's talk about the capital gain and what a qualifying capital gain is. Most of the time we have real estate investors that are on our calls, but this applies kind of in a lot of different areas. Talk a little bit about where the money can come from and what has to happen.
Yeah, I would say the two most common items that we see are either, a sale of some sort of equities. So whether that's a sale of your own business, so you're, selling the stock in your business, or you have a big gain in the stock market. Let's say you're fortunate enough to buy Tesla at the IPO. You now want to sell your Tesla stock. You've got a big delta between what you bought it for or your basis and what you're selling it for. All that money is capital gain. So that's one way. What we've also seen is the same thing when people sell real estate. So most often and most commonly we hear about 1031 tax deferred exchanges. These tax deferred exchanges, people kick the can down the road on paying tax and their basis keeps moving with the transaction. Well, if your basis in a property is $1 million and you sell it for $3 million, oftentimes you just have to exchange the $3 million. But here, what you could do is pull the $1 million off the table and just reinvest the $2 million. So there's the two main ways are, sale of real estate or sale of what we would call equities or securities.
And all the money has to go in, just the gain. Talk about that.
So it's just the gain, and you don't have to put in all the gain either, by the way. So let's just pick an example where, you have, you bought something for $1, it's now worth $4, right? So in a real estate transaction, you would exchange the whole $4. If you're going to use a real estate to go into the opportunity zone, you can take the $1 back and put it in your pocket tax-free. And then you would have to decide how you wanted to invest those remaining $3. You could put all $3 into your self-directed fund. You could put $2 or another fund. You could put $2 in. You could put $1 in, right? And there's different options. You have flexibility. Same thing with a security or like a piece of stock, for example. If you bought it for $1, it's now worth $4, right? You can take the $1, put it back in your pocket, and then you can choose how to invest the remaining $3.
Great, thank you. And just a reminder, or maybe a housekeeping item, if you have a question that you want to ask, use the chat and we'll make sure to get to it over the course of the hour. The agenda for the rest of what we're going to do is really just try to give everybody an overview of the different options and the different things that are required per the Opportunity Zone guidelines. We'll walk you through what the options are. We'll also go through the numbers and then have a couple case studies for a particular segment of Opportunity Zone investing that we found to be really appealing to some of our clients that are looking to maintain control of their own money, direct their own money, but not get too tied up in the day-to-day operations. So
Justin, there's a really good question in the chat. Maybe we can answer it real quick. Chris asked, what has expired as it pertains to the benefits in the op zone in 2021? So there were two different artificial deadlines. One was the end of 2019 and one was the end of 2021. If your capital gain was invested into your fund by the end of 2019, not only did you get to wait until 2027 to pay that federal tax bill, but additionally, you got a 15% reduction in that bill. If your money was in before the end of 2021, you got a 10% reduction in that bill. So now you don't get the reduction in the bill, but you do get to wait until 2027. So April 15th of 2027 to pay the actual capital gains tax at the federal level. The one thing to keep in mind is if, let's just say, Justin, we have 5% inflation over the next 5 years, you would essentially get a natural 25% discount or so using 2027 dollars versus today's dollars.
And Jason, while we're here and while Chris asked the question about let's call it the taxes or the benefits, let's talk a little bit about what are the incentives that have been put in place to encourage and fuel Opportunity Zone investment. You talked a little bit about the expired benefit, but why don't you go into these three things here and talk a little bit about what are the benefits and why these things have been so attractive to the clients that we've worked with recently. I mean, it's been unanimous, not only from the investor, but to all of their advisors as to the significant financial benefit of taking advantage of opportunity zones.
Right. So I would say, Justin, that there's three major benefits. The first of which I just discussed, which is you get to delay paying that capital gains bill, at least at the federal level, or potentially at the state level if you're in a state that recognizes the federal capital gains tax code. California does not. So if you realize your gain in a different state, let's just say Nevada, for example, right, you can actually delay both payments potentially. But if focusing on California, you get to delay the federal tax bill till 2027. And so that's something to keep in mind is when the payments due, time value of money, getting to delay that payment and using, inflated dollars. So that's the first part. The second part is you can actually hold the property until 2046, and any appreciation, any profit you make on that property, you do not pay any tax on. So you can make $100 million tax-free potentially if your property goes up $100 million in value. One thing to keep in mind is you can actually refinance and cash out money out of that property. You have to hold the property for 2 years before you do, unless you're refining the money, leaving it in the fund and buying additional assets. So you could do that within the 2-year period, as long as those assets are in the opportunity zones. But you can refi out money in the future and distribute it. And the other thing is from a tax perspective, and a real big tax benefit, which is depreciation on these buildings. So oftentimes people balance, how much depreciation do they take? Do they want to do something called cost segregation and accelerate their depreciation? But normally there's a downside to doing all of that, which is, when you go to sell the property, you have a huge capital gains tax bill. Well, in this case, when you're not paying any gains tax on the sale, you're incentivized, Justin, to depreciate the value down as low as you possibly can because you're not getting taxed on it. So you do get the depreciation benefit as well.
And as you talked about California a moment ago and how it doesn't recognize the federal, using cost segregation to speed up the depreciation used is a great way to get some of the benefits, some tax benefits and additional tax benefits in California as well. Chris has a question about the threat or the ability of the legislator invalidating, diluting, canceling opportunity zones. I'm going to make a quick comment and then I'll turn it over to you to talk about 26 and 46. But Chris, I think that one of the key points is that, during the Trump presidency, probably the only thing that had bipartisan support was opportunity zones. Maybe the right side of the aisle, it was the tax benefits. The left side of the aisle was the investment in neighborhoods that could really benefit from it and job creation. But equally, both sides were really supportive. We haven't seen or heard anything yet as to I would say any negativity about the opportunity zone program and what we've seen so far. Jason, you want to talk about 26 and 46 as it relates to timelines for what we have now and your opinion on what we're hearing?
Sure. So as of now, I 100% agree with what Justin said. It was a bipartisan effort. I think, both sides of the aisle can get behind the tax benefits for the investors and the neighborhoods that are getting the help and the investment. So I think that those aren't going anywhere. But the way the law is written is December 31st, 2026 is the last day to invest in an opportunity zone. As of January 1st, 2027, the opportunity zones that exist as they exist in theory now do disappear. So you need to have your asset closed in the property by the end of 2026. And then you have until 2046 to make your tax-free appreciation. So if you want the full tax-free appreciation, you need to hold the property for 10 years. And you can hold it up to, now and given the time, you can hold it up for another 24 to 25 years before you'd have to sell it.
Thank you, Jason. Let's move us back a slide just to quickly kind of go through this. So what is a qualified opportunity fund? Jason talked about how you have to invest in a opportunity zone fund. Now, there are two ways to do it. You can invest in one with a variety of different investors, similar to a DST sort of sponsorship investment, or you can create a self-directed fund. That's what we did. Late in December, Jason did it for 4 of our clients who we said saved $5 to $6 million because of everybody's collective efforts to get it done in time. But they created self-directed funds. What you do in that self-directed fund is you can either purchase a business that is operating and creating jobs in an opportunity zone where 90% of its business is generated in the opportunity zone, or you can purchase a piece of real estate that gets significantly improved in the opportunity zone. We'll go into that in a little bit more in detail in just a second to ask Cyrus's question. Chris, I hope it's actually not your last question and you've got some more, but most things you can invest in an opportunity zone. There's a couple things that you can't. They're sin businesses. As somebody who golfs a lot, I'm a little upset that a golf course is one of the things that's not considered a proper investment. But you can see a hot tub facility, massage parlor, suntan facility, racetrack, gambling, sale of liquor, all those things. You can't, if you invest in those businesses, you would not be able to get the benefits of an opportunity zone. Now, Jason, we know you have a lot of cannabis real estate experience. It might be too small to see on the screen for some of us with my bad eyesight, but talk a little bit. I did not mention cannabis specifically. Talk a little bit about that, and then I'll go to Cyrus's question here.
Right. So right now, cannabis is federally illegal. So it is not classified federally in the code as a sin business because they don't see it as an actual legal business. So there is some question now, but we believe that you could likely own own and build out a property and have a tenant in there that is in that space. So we think that you can do that, which would create an interesting opportunity. As we're still seeing today, returns are higher for property owners that do have cannabis related tenants. So it's something to keep in mind, something to think about as an opportunity. And it could be a great play for you. Remember, on all these leases, if you do have tenants, and we'll talk about this further, but no triple net leasing is allowed specifically in the code, but we'll get into that a little more later.
Cyrus, I'm going to answer your question. And it's one that we've experienced a lot, which is I've owned the property in Santa Ana, which is in an opportunity zone for 10 years. If I sell it, is the capital gain tax free? One of the key provisions of the opportunity zone investment is that you had to purchase the property in the opportunity zone after the legislation. So you had to make new investment in the opportunity zones once they were created. So in Cyrus's case, he's owned his property for 10 years in the opportunity zone. He doesn't get the benefits of opportunity zone ownership because two reasons, really. The first one is that he owned the property before it was in the opportunities. It was classified as an opportunity zone. And number two, that you have to make significant improvement, create jobs in the opportunity zone for a property to qualify. Now, Cyrus, in your case, there are things that you've done at your properties over the years that would have made it perfect had at any point, really, since December 2017 through today, you would have taken one of your buildings that you've done such amazing work to, and if you loved owning in that neighborhood, sell it, take the profit and buy a rundown building across the street from you that's still in the opportunity zone, purchase that, and then do all the amazing things that you do to property to improve it and make it really nice. And you would have probably got the significant improvement qualification, and you would have purchased the property in the zone after it was established. So for those of you that have owned a long time in opportunity zones and you like the area and you want to continue to improve that neighborhood, there are ways where you can get the opportunity zone benefits. Unfortunately, the way that it was proposed and approved and signed off on, if you own existing property in the area, it's not going to, your use is not going to qualify. Jackie, you have a great question, and we're going to get to that one in just a second. If you hold on, we'll make sure to cover that one, and we'll cover Chris's. Jason, did you read more on Chris's? I'm just getting there.
Yeah, so I'll answer Chris's real quick. So Chris's question was, if he lives in California now and he moves to Florida, which he may before year 10, can California chase him for the post 10-year gain in the real if it's realized post year 10? So fortunately, Chris, California is going to honor the tax-free appreciation. Now, they are not honoring the delay in the capital gain payment just because of the way that California recognizes the capital gain tax code. So you could move to any state you want to and not worry about the tax on the gain regardless. As part of recognizing the opportunity zones, they have to give the long-term benefit. The difference is California recognized the opportunity zone law. They got the long-term benefit. They have to give that to you tax-free. What they don't have to recognize is what is considered a capital gain, right? That's been in the tax code for a long time. And so that's the difference. So you should be fine. You can move to Florida at your 9.75, right? Or 9.9 and you're still okay.
Chris, that the planning of leaving California for, I guess, whatever reasons, family, taxes, and utilizing opportunity zones to take gain that was in California and move it out is what a number of our clients have been talking to Jason and I about. So I think you're on the track of trying to get as much benefit out of the opportunity zone as possible.
And Justin, really quick, one benefit we didn't talk about of the opportunity zone when we were talking a little earlier, which is kind of prevalent here, is when you start talking about, family and other things, is they have ruled, the IRS has, that the opportunity zone benefit will pass to your estate if the property is part of your estate. So if you are a little older and you think that you might not be here in 2046, and we just never know, but you can actually buy the property in the opportunity zone and your estate can inherit that benefit as well.
It was like you read my mind. You were reading what was on that slide before I even got there. Let's talk a little bit more about timing. For a lot of our real estate investors, they're familiar with the timelines of a 1031 exchange. We'll compare it to an exchange in a minute. But talk about the time that somebody has to, A, get the money in a fund. And there's some variables there as as you effectively worked at the end of December to help somebody who thought they were out of luck. But talk about time to get the money in a fund and time for the fund to invest in a property.
Right. So the time to get the money in the fund is 6 months, but it's 6 months from the realization of the gain. That's where it gets interesting. And that's where things become trickier because there are 3 or 4 IRS definitions of when you realize your gain. So it can be at the end of the calendar year. It can be end of a corporate tax year. It can be when you receive your K-1 from your corporation, or like if you sold a business. So there are a handful of when do you actually realize that gain issue that pops up that we can use potentially to adjust timeline. So for example, we had a client that in May had a huge gain on a stock portfolio sale, right? But he wasn't actually recognizing the gain until his tax returns this upcoming, at the end of December. And so what we did was we had him put the money in, at the end of December, which was after 6 normal months. But because he hadn't recognized the gain yet, which would be on his tax returns, we were able to do it. So it's all about when you recognize your gain. You have 6 months from there to put it into the fund. And then the fund, generally speaking, has 6 months to acquire the property. And then to answer Jackie's question, so you actually have, it depends on how we structure the fund. You can have anywhere from 2.5 to probably 6 years to actually do your improvements, depending on how we set it up and structure it. But the significant improvement number is, I'll give a basic example. If you buy a property for $1 million and the appraised value or the assessed value of the improvements on the land, so let's say the building are $600,000 and the land's valued at $400,000, you would actually have to buy the property with capital gains plus debt and then put in the value of the current improvements in improving the property. So you'd have to buy the $1 million with capital gain money plus debt and then put in $600,000 in capital gain, actually $600,001 in capital gain improving the property.
Thank you, Jason. I'm going to take Bill's question right now. Can you place the property in a living trust? Bill, we'll see if I've got the answer right, but Jason can correct me. The property is in your opportunity zone fund. The
Correct.
Fund would be an asset of the trust.
Correct. And you could even potentially have the member of the fund be the trust itself. So either you individually are a member and it's an asset of your trust based on you individually, or the trust itself can be the member of the fund. yes, Justin, you were spot on.
Getting good at this. We've done enough of these and worked hard enough on it that I think we've found all the opportunities in opportunity zones. Jason, you want to talk a little bit about the difference for our real estate clients that are on the call of a 1031 and versus using opportunity zone to place gain into a property?
Sure. So, as most of you guys have probably heard, on a 1031 tax, it's called a tax deferred exchange. It is not a tax avoidance strategy, but on a 1031 tax deferred exchange, if you sell a property for $1 million, and it's 500,000 in debt and 500,000 in equity, you need to buy a replacement property that's at least $1 million, and you have to have at least 500,000 in debt and 500,000 in equity. You can keep rolling this forward as many times as you want, by the way, so long as the 1031 exchange law exists. It was brought up potentially to be eliminated as recently as last year from the tax code. It didn't get very far. Eventually, I think that there's going to be limitations over time. So doing a op zone deal is a hedge against that. We'll talk about the op zone mechanics in a second. The other thing is eventually over time, if you keep exchanging and your estate inherits a property, there's a step up in basis. The estate still has to pay inheritance tax, but the basis is stepped up because they're paying the inheritance tax. On the opportunity zone deal, you would sell the property, and like Justin said, you can take the basis off the table. So if you have, you bought it for $1, you can take the $1 back, and then you have $3 in profit. You can reinvest those $3. The short-term downside is you have to pay your California tax. Well, now it would be in 2023. You'd pay your California tax then. You would pay your capital federal gains tax in 2027. So the difference is if capital gains rates go up, you at least know what your rates are. You're locked in now at a fixed tax rate. Your basis issue gets resolved in the future if they eliminate it, step up in basis, because it's inheritable, the benefit by your estate. And so the basis doesn't become an issue when they go to sell it. And then again, you get all the appreciation tax free, and you can invest the money in a directed fund of your choosing.
Fantastic. We're going to get in a little to some of these things as we were talking with Cyrus and his question about do I get the benefit because I own an apartment building and have owned it for 10 years? A big part of the opportunity zone is this idea of original use and making significant improvements to the property. And what we mean by that is, as Jason was talking with Jackie as well, that if you have a old rundown property, and let's say it was an apartment and there was 4 units and it was a huge lot, and you were going to add 10 more units to it. Well, the addition of the 10 units would have to equal the amount of basis, or meet the value of the improvements already existing. But also the new units would have to have their original use during your ownership in the opportunity zone. So if you were to build those new 10 units, their original use date would be the date of certificate of occupancy or when you start collecting rent. And they would qualify as original use because you built them after the opportunity zone was you purchased the property in your fund after the opportunity zone legislation was enacted, and then developed it at a amount equal to the value of the improvements when you acquired the property. Jason, any additional comments on that? Maybe we've got a little bit in there about how raw land, if you just buy land and keep it as land, it doesn't qualify. Right. Or how long you have to improve it.
Right. And so, the raw land thing's been really interesting because there's no value. So people are like, well, if I grade it, does that count? Well, no, because you need to have it like, as Justin said, you need to create an original use. So you could grade it and turn it into a parking lot and have employees at the parking lot and get a certificate of occupancy as a parking lot. But just raw land, you can't use it as a land banking deal. That won't work here, unfortunately. Jackie had a very interesting question too. Why can't you use surplus funds, invest those into an opportunity zone and still get the benefit? What is the incentive factor to restricting this to capital gains? So Jackie, I would love it if they would let us use regular money in this. what the government found was that there were a lot of what's called unrealized gains in the market. So people that had large gains in their stock portfolios over the years, they were just afraid of selling them. So what they were trying to do as the government was incentivize people to start realizing certain gains through sale of assets, and incentivizing them to do so by creating this go forward opportunity, right? Like the money that's sitting that you have that's excess funds that's just sitting in your pocket. You've already paid taxes on those. The government's not going to be making any more tax on you investing it right now. So what they're trying to do is incentivize people that have taxable income that they haven't realized yet to realize that taxable income so they could get taxes now. So,
John, and I'll take yours. What happens if I sell before year 10? So part of the provisions of the opportunity zone is that if you hold a property in your opportunity zone fund for 10 years, you get not only no tax on the gain that you make from that purchase and period of time that you were in an opportunity zone fund, but there is no depreciation recapture. So if you hold for less than 10 years, there is some clawback to the amount that you get to avoid on your taxes. A lot of this, or why we've got particularly in 10 years, is because we're going to talk about passive investments here in a minute, and net leased or quasi net leased properties. And usually those are for a significantly long hold because they have a 10, 15, or 20-year lease attached to them. Now, the one thing about it is you have to keep the money in the fund for 10 years to get the tax benefit, all of the tax benefits. You do not have to own that single property for 10 years. So in theory, a developer could go acquire a site, build a property, sell it to an investor who would receive the opportunity zone benefits prior to certificate of occupancy, and repeat that process 3 or 4 times in the 10 years, just keeping their investment dollars in the fund. So you're not limited to where you have to hold one particular property for 10 years. You just have to have your money invested in the opportunity zone fund for 10 years. And you could, Jason,
Justin,
go ahead.
Oh, I was going to say, to your point, they don't even have to sell it to an opportunity fund buyer. They could sell it to anybody as long as they reinvested the money into the opportunity zone, again, and buying a new deal. We have some clients that are looking at, buying, single family homes on large lots or duplexes and using SB 8 and 9 if they can, and doing that a few times if they can turn it a few times and end up with a bunch of extra assets because it's, they build a few, sell them, buy a few more, and are able to scale so that they can get some more scale because they're just professional developers.
Jason, let's talk a little bit more about this, because I think a critical thing when we talk about acquiring some of the properties later is this idea of placed in service and when original use occurs. Because one of the opportunities for investors is to buy a property that is currently under construction prior to receiving the certificate of occupancy. Jason, you want to talk a little bit about kind of that opportunity that we found for somebody who doesn't have a lot of experience building, doesn't want to put their money at risk to be the developer, but wants to invest in opportunity zones, wants to contribute to job creation in these areas, and also get the tax benefits, how they can do it, and how this placed in service or state of readiness is a critical component.
Right. So to Justin's point, what we found is, you can, as the critical date is the placed in service, right? So oftentimes I will refer to it when we're not getting highly technical as like when you receive your certificate of occupancy, when the building is ready for service, it's ready to be used by a tenant. And so before that point in time, if you buy a property, you actually, as the purchaser, get credit for all the improvements done by the builder developer that's been building the new construction property. So you get the benefit as if you had built the property yourself for all the improvements already done. So, we'll go into some examples later in the slides about deals we've done, whether it's a Chipotle or a Burger King or some other assets where we've actually helped clients identify and buy these properties. We close, anywhere between 2 and 4 weeks before the certificate of occupancy, right? Because generally speaking, oftentimes the place into service, one of the other indicators is, when is the property available for rent? And oftentimes on these, let's just call them double net lease transactions, the lease starts and commences for the tenant the day that the building is ready to be occupied, which is the certificate of occupancy. So we tend to use that as a hard date on when, the improvements stop and the tenant can take over. So anytime we close before that, you actually, as the buyer, get credit for those improvements.
Thanks, Jason. As we've started to navigate this stuff, the next one, and Jason mentioned it earlier, is leases and utilizing the provisions to structure transactions that work for people who want fairly passive, but not completely passive ownership and operation, both from a developing the site aspect, but also from a go forward management standpoint. So Jason, you want to talk a little bit about lease structure and how that plays into qualifying for the benefits of an opportunity zone?
Right. So something that Justin and their team and the team at Centennial were able to figure out was, I went to them and said, look, these triple net leases are just not allowed, right? Because the whole point is it's supposed to create active jobs. There's supposed to be active management and activity in your investment. And triple net leases are specifically called for in the code as being excluded. And Justin said, well, what happens if we find a way to do a double net lease? And we can structure the double net lease to have benefits, but it's still a double net lease, right? Like you as the owner are responsible. So what we've been able to do is, for example, unlike our Burger King in Indiana, it's a double net lease, but there's a every 5-year rent adjustment for additional rent. That additional rent number is tied to, a certain factor that might normally be included in a triple net lease, but it is a double net lease. It is our job to pay that. The reassessments occur every 4 years. Our reassessments occur every 5 in the lease. And so that is an opportunity to transition a lease. Our Chipotle in Virginia, for example, the owner is responsible for, I believe, just in roof and structure, right? And so the tenant takes care of everything else. But should there be a roof issue over the tenant doesn't have to take care of it. We as the landlord would. But again, we're buying a new construction building and the roof has a 20 or 25-year warranty on it. So there shouldn't be a lot of issues for our client. So the goal is to structure it in a way where it meets both the IRS requirements for opportunity zone leases, but at the same time, give the client the least amount of management required.
So we've gone into, I guess, some of the detail on some of these key and critical aspects about how you qualify, what works, what doesn't work. And now we'll spend a minute just kind of summarizing the benefits of the opportunity zone. One, as Jason mentioned, you defer capital gains until December 31st, 2026, really April 15th, 2027. And you can use the money that you have deferred to ultimately, reinvest and pay those taxes that you owe. There is no capital gains tax on the gains made in the opportunity zone if you hold the property for 10 years. You've got the flexibility to move investment dollars to multiple opportunity zone businesses or properties during the existence of your fund. As Jason mentioned, you have the ability to take distributions from the fund after 2 years, and you have the ability to finance the acquisitions of the properties from day one. There's avoidance of depreciation capture when there's a 10-year hold in the opportunity zone, not the particular property. Obviously, if you own the particular property for the 10 years, that would more than satisfy. There's ability to use cost segregation to enhance the depreciation benefits during ownership and get benefits across your entire portfolio if you're using cost segregation in the early years to offset gains on other properties. And it may be a better tool than 1031 exchanges in some cases for tax deferral and tax incentives. So there's a number of benefits to the opportunity zone investor. What we found in a lot of our conversations over the last few months is that there are a number of financial professionals, wealth advisors that are exploring and trying to utilize opportunity zones. And there's some benefits for the wealth managers as well. One, with some of the structuring and the way that we talk about the investor being able to control their destiny, is that you can provide single entity ownership options for your capital gain clients that have sold a business, an NFT, are in a limited partnership going separate directions, whatever it may be. there's available projects have a variety of return and management characteristics. We'll go into kind of the three easy options that investors have when it comes to choosing the right opportunity zone fund in just a sec, or opportunity zone investment in just a second. But there's a lot of different options, from a 40+% IRR mining opportunities that I've seen to some very stable, conservative, corporately backed leases are options as well. The other thing for the wealth managers, the Opportunity Zone Fund requires management of the fund's assets and the execution of the fund's systems, processes, and utilization of the capital that's in it. Jason and Centennial can partner with you to set up the fund, find the appropriate property for the fund, obtain debt if needed, and administrate and determine if there's times where maybe selling one fund asset and redeploying into a new fund asset is appropriate. And then we can consult with you throughout the opportunity zone ownership to evaluate the effectiveness of the asset's performance, and if there are alternatives that better meet the client's objectives. Jason, any other things, whether it's for the investor or for the wealth manager, as it relates to opportunity zone investments?
So I think the one thing that we're seeing a lot of, and Justin and I are dealing with this on a daily basis now, is it's a really great tool for estate planning. Whether you have a large inheritable number that's in stocks, and the person giving those, right, the person gifting that down to their children or grandchildren doesn't want to just give people a pure number in cash. They don't want to, they own real estate now, but it's active management real estate, apartment buildings, and other items, or they just don't. The children or the people inheriting it don't. That's not their business. That's not what they want to do. They don't have any interest, right? There's a lot of opportunity to take some of that wealth and create, like, if you sold a few $1 million worth of stock, and you had 3 kids, you could buy each of them a building. They each get cash flow over the next, 20 years. And then 20 years from now, they can sell it, but at least it sets them up with cash flow. So we're seeing it really effectively being used from an estate planning perspective, where people have big gains and they want to give their, children or their grandchildren consistent cash flow over time. And or they have real estate, want to keep the family in real estate, but in a different form of real estate that's better for the next generation. And so those are some really good opportunities to think about. They also give you certainty as it pertains to, elimination of 1031, step up in basis, tax-free, appreciation and growth, which is a huge thing for, any potential changes in the future in estate planning. So it's just a really good time to think about it.
And when you're thinking about it, there's a bunch of different ways that you can do it. Certainly, since the end of 2017, the invest in a fund in a really large project that's very passive, from acquiring, investing pre-acquisition of the ground all the way through completion of the project, has been the most common opportunity for Main Street investors. Jason and I think that there's a different one depending on how you answer the next 3 questions. If you're on the right side every time, there's a different way and there's a better way. So how do you invest? Do you invest in large projects with other people where you have no control, or do you create your own self-directed fund where you call all the shots? The other options do you have? Do you buy a business that creates jobs, or do you buy/build a property that creates jobs? And then the third one is you figure out what you want to do. Do you want management intensive and significant and the highest possible returns with some risk? Or do you want stabilized, very limited management properties with predictable cash flows? We've fortunately had the opportunity to discover the opportunity, or the secret in opportunity zones, as it relates to self-directed funds, buying properties under construction, creating a long-term lease structure with very limited active management for our clients to provide them a very predictable cash flow. And we're going to walk you through a couple of these examples of some of the transactions we've been doing. Jason, you want to talk about this one, or you want to talk about Chipotle?
I'll let you talk about Burger King. I'll talk about Chipotle.
All right. So Burger King, this was an asset brought to market. Carroll's Corp is the largest Burger King franchise, publicly traded. They acquired the land to build a brand new site, acquired the land in 2019. And this is a rendering of the Burger King because our client purchased the property, closed December 31st for a early February certificate of occupancy and grand opening of the site. It has a 20-year lease, and our client was able to purchase the property at a 5.5 cap with a 20-year lease and publicly traded operator because they wanted to close by the end of the year and didn't realize maybe all of the opportunity zone benefits that they were offering in the property. It's located just outside of college campus. The buyer deferred over $400,000 in capital gains, and they're going to pay zero taxes on all the future gains. And has really been as we've worked through the process, negotiated what was a triple net lease into a double net lease, as Jason mentioned, with the taxes being the only thing that the owner is going to have to pay. And there's in the lease a plan and a system for how the tenant and the landlord are going to deal with tax increases or property tax increases. The property is going to provide a great return and all the opportunity zone benefits without our client ever having to actively manage the development of the site or to spend a significant amount of time managing the property. Jobs are created both in the construction of the Burger King and in the operation of the Burger King. And our client, who sold significant interest in their business, was able to avoid the capital gains.
So similar style transaction here with the Chipotle in Virginia. Chipotle is guaranteeing the lease and signing the lease. Chipotle is, I believe, corporate owned on all stores. They're getting close now to 3,000 locations. I know they're currently about a 2,850. I think they'll be at 3,000 before the end of the year. You can see the improvement in the stock numbers and the success of the company. 15-year lease, great neighborhood, great area. Originally started as triple net. In this situation, we went to, the client is going to be responsible for roof and structure. But as I said earlier, right, you have a 20-year warranty on the roof. It's brand new construction. We don't foresee any issues. It's in a great neighborhood, great area with a high area median income within a mile. And again, we're going to close this one. We're closing this one actually on Monday. And then the tenant will take occupancy by the end of next month, with the C of O coming probably the third week of February.
And so the first two examples are net leased, passive, collect that check every month. Some of our investors want to get a little bit more return and take a more active management role. And the next one that we're going to show you is an apartment asset that's actually currently available here in Southern California. Just under $10 million for brand new construction. Certificate of occupancy is going to be delivered in the spring with full lease up, probably being sometime by the end of summer. This is in Anaheim, right, just east of downtown Anaheim, kind of between the stadium and downtown Anaheim, close to the packing district, all those things. 33,000 square feet of brand new construction building. So it's not just the double net leases, passive opportunities that are available, but this is another project that's going to be completed by the developer, going to close escrow prior to the certificate of occupancy and tenants moving in, so the investor can get the benefits of the opportunity zone ownership without having to do all the work to get it there. Jackie, to your question, yes. In these three examples, our clients are buying from the developer, and Jason works with the attorneys involved on the other side to create the protections that our clients need, that the development is going to be completed, all the way through everything that needs to be done, and the quality and the craftsmanship is going to be there, so that when our investor does take ownership of the property, they've got a completed building that's ready to be occupied and put into use.
And keep in mind too, Jackie, one of the great things is oftentimes that these developers, like Carol's built their own building, right? So the Burger King was built by the person selling it to us, who's going to become the tenant. So they're incentivized to complete it. In the Chipotle situation, it's a company that's built, I think, a few hundred Chipotle facilities. They're one of the go-to spec developers for Chipotle. They don't want the reputation of not completing. Justin, I think one of the other interesting things I've noticed is not necessarily as much with the Chipotle, but with the Burger King and with the Anaheim is clients are getting a little bit better cap rates on some of these deals than what might be traditionally at like market with them being completed and tenant already in the door. Is that something you guys are seeing?
Yeah, we are seeing that because of the deliverability moment, I would say in these transactions, that our clients are getting a slightly higher than market cap rate because they are buying the property before it's quote unquote totally done. Um, the risk, certainly in the case when Carroll's Corp is building the site that they have handpicked to operate, is very minimal. I think that, in this case, with a Anaheim apartment building where occupancy is 97% plus throughout Anaheim, new rents have grown probably 5 to 8% in the last 18 months when there's a new tenant moving in. The probability and likelihood that you're going to end up with an empty building is minimal. In this case, our client, we're going to make some recommendations on who they bring on to, one, lease up the property where it's somebody that's what they do really well, and then who operates the stabilized management on their behalf, so that somebody who may have operated a business really successfully but never successfully owned an apartment building can easily transition into operating those assets and being, a successful multifamily owner in this case.
I really like this Anaheim asset too, Justin, because even if you held it for 13 years, I mean, you're not going to get the full 24, but you could keep yourself out of the rent control time, and like right before the building would potentially be under statewide rent control, you could offload it to like a big institutional player that would come in and get it ready for that as well. So there's a lot of real upside in this transaction.
Yeah, this one we just found the other day and thought it was a good opportunity for someone looking for something slightly different than the Chipotle Burger King option, but equally wanting to get into opportunity zones and benefit from a brand new construction property that they would be able to get all the benefits.
Well, and you can get a lot higher leverage on these deals as well. So, and
Yeah.
the cash out refi process over the years, there's some really attractive items about this apartment building.
So yeah, those are some of the examples of transactions we've been working on, as well as what we think really the secret in opportunity zone investing is. Over my 20 plus years in the business, I think most of the clients that we typically work with want to be in control of their own money. They've successfully done that for all of their investment career. And with Jason's help and the right structuring, we figured out ways where they can continue to control their own destiny, be the single voice making the decisions, but also be able to get the opportunity zone benefits, whether it's in a net lease property that's going to provide very stable cash flow with, very credit-worthy tenants, or something like this apartment building. Jason, you have any other closing comments on what we think is the secret in opportunity zones for our clients?
No, I just that keep in mind there are a lot of benefits, and you might run your models or your analysis on transactions, and it's something worth really sitting down and talking to an advisor at Centennial about, because how do you underwrite not paying tax on appreciation? How do you underwrite or think about for our client that's buying the Burger King, we're doing cost segregation and accelerating his depreciation through his business sale. He actually is going to get additional capital gains payments this year. Through the accelerated depreciation, he's likely not going to have to pay any taxes on those payments because the accelerated depreciation offsets that gain. So there's a lot of different tax benefits that we wouldn't normally think about in a traditional real estate transaction that'll play into effect here. So the benefits are huge across the board. I mean, to the point that, just Centennial is a client that I'm fortunate enough, hopefully we're meeting with tomorrow, where they have a property where they were going to sell it. They bought it for about $6 million, and they're going to sell it somewhere between 80 and 90. I know it's crazy. And they're originally thinking we have to exchange. But I was like, maybe we think about opportunity zones, the key principles in his 80s. The kids don't want to, manage active properties necessarily. So we can set it up so there's a number of properties for each kid or each child or each inheritant. And that's just something to keep in mind. Additionally, like they're structured as an S corp, right? Going to do an exchange or step up in basis from an S corp versus an LLC are difficult. But if we do the op zone, it takes all those issues off the table. So, talk with an advisor, sit down. They'll help you see property types, but they can also help you understand all the different benefits, whether you're a financial advisor helping your own clients or an individual investor.
Yeah, and in closing, I'm just going to show you on this slide in the bottom of this center column that compares the qualified opportunity fund investment versus buying a property outside of an opportunity zone fund, that the benefit when you add up the taxes, the ability to use your capital is significant. You know, in this example, it's 41%. Is it always going to be 41%? No, but there is significant benefit because of the ability to control your own capital for the additional years before you have to pay the capital gain tax. And then by using that larger amount, the gain that you get and the depreciation recapture that you avoid significantly benefits the investment. And so, Jason, I appreciate you being on the call. I appreciate what you did for our clients in the last few days of December and setting up funds and getting them in a very confident and comfortable place about what they could do within the Opportunity Zone Fund to successfully avoid the tax and make great investments in the future. As always, it's our pleasure to talk with you about some of the things that we think are great opportunities for you. If Jason or I can be of any assistance, please reach out to either one of us. We're happy to help. As I said, the last one of these calls we did was probably our most successful because we helped people save $5 to $6 million, or help 4 clients save $5 to $6 million in their taxes by utilizing Opportunity Zone funds, and we'd love to help you all do the same. Thank you very much, and we look forward to talking to you soon.